So the section one is the origins of the model. So this was big in my development, and when I started to understand the cycles, it was really about, why do these cycles keep showing up in nature? And if you study anything like, Dewey was one of the main founders of um, foundation of study of cycles, and he's written all kinds of different books on all the different cycles from turtles to human cycles as far as your moods and everything else. But when you really get behind the science of it, the way the whole universe and the cosmos is all cyclical, it's all energy. It's a wave, they call it wave formation vibration. And why that's important is because the markets it's just a pool of energy, right? And so the price action, the humans are what's moving through that energy field, right? The markets is the medium. Just like a wave moves through water, the energy is moving through the water, which manifests itself in a cycle. That's how it travels. So even light from the sun, I mean, everything moves. That's just how energy is transferred. And that's kind of the basics of how I designed the model. So obviously there's all types of different cycles, right? There's time cycles, calendar cycles, cycles in physics, planetary cycles. And I would encourage you guys to study this stuff. It's pretty interesting. We were chatting about the moon cycles in the Slack room the other day. So it's kind of when you're aware of this, it's really everywhere. It's obviously very, very much in the markets as well. So there's different lengths of cycles, right? There could be a cycle on a specific pair like the euro that we're trading. But we can also take these cycles into the global macro picture, the business cycle. And so it's a pretty basic concept that's taught. But what I'm going to show everyone here in a second is, and you guys know that I teach that's the 8.6 frequency that Martin Armstrong really discovered. And so, well, let's just get into that. So a lot of you know Marty. If not, you can look him up. I think the guy probably deserves several Nobel Prizes in economics. He's got quite the story. So he started out as a gold trader. Was one of the biggest, if not the biggest, gold dealer and trader in New York and London. He used to trade against all the banks, and he always kind of had a feud against them. But then he started an advising firm, and I think at the time they probably had, well, here on this slide, like I said, they had $3 trillion. This was back in the 80s under contract, meaning he advised that amount of assets. So he would fly around the world. He built probably the most impressive, if not the best machine, or you have the IBM machine called Watson that's out there. Well, his machine's called Socrates, and he's actually way ahead of what they're doing at IBM. But that's kind of besides the point. But what he did, he started out as computer programming and as a trader, and then he kind of merged the two together. But he started researching cycles and trading at the Princeton Library, and what he found is when he originally started studying the financial panics, I forget the exact number, but he took a span of 224 years, and then what he found is that about every 8.6 years there was a panic, and then he kind of started to dig further into that concept, and kind of just what he discovered was this rhythm, and he called it the global economic confidence model. And so this was the cycle of confidence that the globe kind of just goes back and forth, ebbs and flows on. And so, I don't know if can you guys see this? This is 1903. There was a panic called the rich man's panic. That was at the high in 1903. And he did this down here. The panic in 1907 was at the bottom of the cycle. And what you'll find though is that all these markets are connected, right? And so, in cycle theory, you guys know I teach on this, but when you have a cycle, it doesn't mean that price is going to top out right on the high and then bottom out on the lows. It's the rhythm that counts. So sometimes you might have a market come down here and bottom, like here. This was the low in U.S. interest rates in 1908. So at this point, the cycle is bottoming. So you got a low in rates at the bottom of the cycle. But more than likely, there was a peak in something else at this point in time. So sometimes you can have what's called a cycle inversion. So a market will come down and bottom with the cycle in price, and then head back up the other way and top with the bottom of the cycle. That's the cycle inversion, right? So when price is going one way and the cycle is topping and kind of they're cycling opposite each other. Anyway, so you guys get this, and I've done this on the on this frequency for some of the more recent events, but it's pretty cool. So here you can see in the top of the cycle, here 1929, Great Depression began, right? Here at the bottom, U.S. valued the currency by 69%, 1934. On this next minor turning point, you had the panic of 1937. So you can just see how all these, and it's just amazing how all these different events sometimes line up to the exact high. Like here, you had the peak in the Japan real estate. It was right at the peak. Here was the reaction high in the Nikkei. This was the gold low and the yen high, 1977. $100, $100 an ounce for gold. 1987 crash on this turn. That was to the day. So pretty fascinating stuff. But this is just one cycle. But this is the cycle that represents the global business cycle. Yeah, so this is a little bit of history, and this is a little bit of physics, thermodynamics. So this I kind of already explained. Yeah, it was a period of 224 years that Marty discovered this. So from 1683 to 1907. And you divide that number by the number of panics, and that came to 26. And that number comes out to 8.6, the decimal. And so what's interesting about that is 8.6 is actually a derivative of pi. And I'll get into that in a second. So pi being the perfect cycle, he started to realize that, kind of the cyclical nature of markets that applied to really everything. So when I was building the model, I was studying these types of things even before I kind of came across Marty. And then I just that kind of emphasized and reinforced everything I was doing. But I mean, you can see these wave structures in the markets. And, I've argued with hedge fund guys because, I mean, when the economy is slowing, like at the beginning of the year, GDP was up here at 3.3%, and now we've slowed to about 1.5% growth year over year. So up until this election, it looks like we were sliding into 0% growth, right? And that still may be the case. But we'll see. It's possible that whatever Trump wants to institute from a spending perspective actually gives the economy a jolt, and this starts to turn back up sooner than we think. But the point is I guess, when we were up here the end of last year, I was arguing with guys that, look, we're at the peak of the cycle, and those types of traders that don't understand the cycles, they always want to say, well, you need some black swan event, you need some particular, you know, geopolitical crisis. They like to argue that you need to have some event to turn the cycle down. But that's just not true. I mean, you don't need any event to keep the sun from coming back up in the morning. You know, even if you put your hand in the air, you can put your hand in the air and just leave it there. I mean, you don't need an external event to get to the point where your arm gets too tired that it has to drop back down. It's just an energy flow. So when you kind of get your mind around this type of thinking, that there's more going on in the markets than just listening to CNBC or chasing the fundamentals, this starts to make a lot more sense, and you're going to have more confidence because, you know, it's more about the timing is right for it to turn, or just the cycle slowing enough by itself is the catalyst for it to turn back up. You know, just in rate of change terms, that's just how the data functions. I think you guys are on top of that. So, with these electric fields, though, there's also electromagnetic wave that goes perpendicular, and that's what holds the two together. And it's been kind of linked that volatility in the markets is similar to this part of the wave, right? So when you have, you know, the S&Ps crashing, the volatility is spiking, all right? So it's kind of interesting that the volatility almost acts like this band that holds the two from going, you know. It's just the same similar relationship. I don't know, hopefully that makes sense. Here, this next slide kind of, so he even uses that in what he calls his schema frequency. So he built this into his computer, and it's really complex code. The CIA wanted it. He refused to give it to him. It's just crazy stories that guy has around what the government did to him. But I don't really want to get into that. You guys can kind of read up on him if you want. He's got a great blog, and he just did his economics conference down here in Orlando, actually. I wanted to go. I'm going to try to make the next one he has in the States. But anyway, this is the same thing that he's trying to show, is that you have one wave here, this is price, and then usually you have an amplitude or a volatility wave that's moving in a similar fashion. So here we go back on the 8.6-year frequency, and then what also you'll find too in markets is these smaller waves, and this is true even in a river, right? These smaller waves build in intensity into bigger waves. And you can just see that in anything. You know, in the ocean, that's how you get a rogue wave. It's a bunch of little waves that kind of, I forget the scientific term. It's not conflux. It's anyway. It's when the rhythm of the waves join and they come together, that will build into these larger waves. So it's true within the economy. These 8.6 years will build into years of 51.6 waves. And this is just explaining the difference in cycles. So what you'll also find, you know, this is big picture, global macro stuff. But when it comes to the economy, you're always kind of having the pendulum swinging back and forth between confidence in the public sector and confidence in the private sector, right? So, and this was the peak in interest rates to the exact month and year. So this was the peak of a public wave, of the peak in confidence in government. And then now we're currently on the private wave. And so you're starting to see that shift now where, I mean, we can see that trend globally where there's complete just breakdown in the confidence of some of these governments, right? And so that's more than likely going to manifest in some sort of major sovereign debt crisis. I mean, we started to see that in 2009 with Greece, but that's really just the tip of the iceberg. So the reason the world is having such sluggish growth is because we haven't dealt with this debt. And it's pretty much every Western country at this point. And you also find, guys, too, that, you know, just like yin and yang, you can't have every country in the world having a surplus, right? A certain amount of countries will have a surplus while a certain amount will have a deficit. And so right now it's the West that has the deficits, and it's the East, mainly China, they're the creditors, right? And that just throughout time, that shifts. So it's been India, then it shifts to, you know, Amsterdam, and then it's shifted to parts of Europe and London. And then so there's different places in the world. You just can't have everybody running the same. It's just not how it works. So right now, if we go into a sovereign debt crisis, more than likely it's probably going to play out into this wave, 2032. And I mean, who knows what that's going to look like. But if there's a huge restructuring or a new monetary system, because we got to get rid of the debt somehow, whether you inflate your way out, whether we restructure, or whether we just have a nasty deflationary default like we had in the Great Depression. That could be a time where we see capital just flee the bond market and move into private assets. And so the last time you had a big private wave was the Roaring '20s, and that's when the stock markets and real estate was doing well, and that concentration of capital was mainly in the U.S., but that was your last private wave. So it's really interesting to me that here you had the Roaring '20s, here you had the high in interest rates on this public wave, and then I wouldn't be surprised for us to see some sort of major global stock market boom again into 2032. And that doesn't mean it needs to start from today, you know. We could have a nasty 2008 correction here, like we had here. But I think you guys get the point, right? So this is just showing you the waves and the cycles exist on the extreme long-term time frame, as well as the shorter time frames, which we care more about as we get into the actual, you know, the trading. But again, these are the concepts that we kind of have to lay the foundation to kind of understand what it is we're trying to do. So you guys seen me do this wave before. I did this on looking at things in Bloomberg, and just show you, and then I'll show you some charts to give you exact examples. But this was the precise low in the equity market in 1994. It was with the exact day with the low of the cycle. I didn't have anything in 1996 that popped out, but the Asian currency crisis started on this minor turn, right? And then 1998 was the exact high to the day. And that's just, when you start to see all these events, guys, to the exact day, that just tells you that there's something else going on, and there's a hidden design in the markets. It's not, there is a cycle, there are, these things play out, and time, the timepiece is the hidden order. And if everything's connected, that means everything's coming up here, something's topping, while at the same time something else is going this way, something's bottoming. All right, and so it's just a whole ecosystem like a rainforest. Everything's connected, but there's this heartbeat that's going through the whole thing. So then on this side of the wave, so this is usually the peak in confidence in some market or some area of the world, and then you have a drop in confidence. All right, so on this side of this wave was the collapse in long-term capital management, which basically manifested in Russia defaulting on their bonds, and those guys had to be bailed out. They were basically buying Russian debt and they were trying to play the yield curve, thinking that it would never invert. They were only back testing like 50 years. These guys, classic academics. They think they're so smart. They came up with a model. They only back tested maybe like 100 years. And any real trader knows that that's not enough time. I mean, these are 300-year cycles that play out sometimes. So when that started to go against them, they were counting on Russia to bail them out, and Russia just couldn't do it, so they defaulted. That's what happened to long-term capital management. And then here on this turn, we had a low in gold. Bounced. This was the internet.com bubble, right with that turn. And then stocks bottomed here in October. So it bottomed a month before the actual turn in ECM. But the way to play this, guys, is when you start to realize these turning points, and I've shown you this on the S&P, on the daily level even, what you want to focus on is always want to think about this is a global model. So where's the peak in confidence? And usually the capital will fly around the world. So, for a while there, in the 80s, it was Japanese capital was pouring into the U.S., and they were buying, you guys know the stories. They're owning things like Rockefeller Center or whatever downtown. So the capital will fly around the world, but it concentrates in usually one sector, one country. All right, and then so in 2007, all the capital was in the U.S. and not all of it, but in the U.S. real estate market. And so that peaked to the month, and then this was the down cycle in real estate. The real estate bottomed here in 2009 on this turn, exactly to the month. You also had Greece start the IMF bailouts with that turn, and then commodities peaked here in 2011. So this just goes on and on throughout time. Anyway, I like this stuff. This is just good history. So here I overlaid real estate. It topped exactly in 2007 with the cycle, and then this is just amazing. This is just proof of why the cycles work so well. Top to the exact month. Then you went one cycle, two cycles up, and bottomed on this turning point exactly. I mean, that's just amazing. So, a quick teaching point, guys. The bull markets are slow to rise, and then obviously, the bear goes out the window, right? Bull goes up the stairs, bear goes out the window. So typically, a bear market is 2 to 3 years. If it goes past 3 years, then you're looking at a prolonged type of bear market. And you get into some of these other Fibonacci counts, like, 8 years, or sometimes it can last, I think gold was in a 13-year bear market. But the typical reaction should be 2 to 3 years. So that's pretty much what you had with real estate. When it's a really hard correction, you don't, like 2008 too, right? It was such a hard, violent correction, you don't really expect that to go on for 13 years. Otherwise, you would retrace the entire move in the stock market, basically back to zero. So that typically doesn't happen when you have a hard sell-off. So I've updated this one. Commodities peaked, like I said, 2011. Obama was urging Congress to do some stuff with Fannie and Freddie there. That wasn't very major. But here, this is when the euro started to break down long term, and it's still been in the same downtrend. And then the dollar broke out here in 2014. So that trend's been in place for 1-2 cycles now. I think we're probably going to get the low closer in the euro, closer into this turn, into par. But it also could be possible euro collapses all the way into 2020. I think that's too long. I would be surprised if we get a low in euro in next year, kind of into that par area. But when you start to understand this time component, you can start to make those types of calls, or at least you can kind of think about, okay, the euro might have a lot more downside than this was this last October, 0.825. If you times that by 365 days in a year, sometimes you have to use a leap year, it's 366 days. That'll give you a number, and I have this in a spreadsheet. But the number will give you the actual calendar day. But this is October 28th, I think it was. So we didn't get a low there. So to me, that tells me the long-term trend is probably at least into this, potentially this turning point. And I would just say, guys, here what peaked on this last wave, was actually a peak in government. So this is a collapse in confidence in government that we're witnessing, and it's happening on a worldwide basis. So this is Brexit. This is everything that's been going on, with Trump and everybody. This whole anti-establishment wave. Russia moved into Syria, started bombing to this exactly to the day. And so when that happens, you kind of focus on that type of event and think that, okay, that event might be the focus for the next 4 years. So Russia, war with Russia, World War III, I mean, that's probably going to be the focus into 2020. It was interesting on this day, guys, to the exact day, was the FBI stuff with Hillary. So see how it's just more government. It's all related to this collapse in government, and that's just kind of where we're at on this wave globally. The last one was real estate. Anyway, I'll keep moving on. You guys get the point. Well, that stuff's cool. So that's the longer-term business cycle. I've overlaid it on the Dow. This was 1929 to the exact month with the ECM, the top in the ECM. They actually broke out in 1925 from this old high. We broke out, and then you rallied from 4 years all the way into the top. Boom. All right, and then there's, you just go through time here. There was a base, and then it broke out, made a high with the exact month here on this turning point in April. Then the Dow bottomed here in 1942, rallied again 4 years. It peaked before the top of the ECM there, but still a nice 4-year move. Here, the Dow broke out through that high, 1951, and then just exploded all the way 4 years in the top of this cycle. All right, so I'm going to skip some of this. So this was just a chart I drew back in like 2012, and you can go look, but this is Dow 18,000 up here. Guys, I drew this in 2012, and the Dow basically did this into that high. And then I'll show you guys too these regression channels I like to use. But this is a great way to kind of plan when you might run into the top of a trend. And so I still think that the equity markets have a good chance of seeing a 20, at least a 20% correction, especially if we roll into recession. I mean, this Trump election's kind of changed everybody's thinking. It's only been not even a week, a little over a week. That's just a little history of the global business cycle. All right, cool. All right, so a little bit about pi. So, most of you, everyone, I don't want to talk down, I just assume that everybody's familiar with the constants of pi and math and school and things growing up. But we know that's the perfect cycle. And so what Marty and they discovered is 3.14. What's interesting is if you take that times 1,000, you come up with 8.6 years. So how about that? It's 8.6 years, which is 3,141 days. So it's a derivative of pi. Pretty amazing, right? And then, there's another number that kind of will play into these cycles is 13. So if you divide 13 into 8, you get the same 8.6, and you get the same fraction. So these things always are showing up in math and geometry. So it's the same stuff. It's everywhere. And then even the Earth's, the axis of the Earth rotates on 25,800 years. So check this out. So there's that same fraction, right? If you start playing around with the digits and the decimals and you subtract 1, it keeps returning you to the same spot. But 53 minus 1 is 52, which is twice the unit of 26. So not only is 8.6 years equal to the perfect number of pi times 1,000 days, what also emerged was 8.6 times 3 is 25.8. And the precession of the equinox is 25,800 days. So this is the same cyclical design that's going on. It's just everywhere. I think that's a cool one. Very cool. All right, and then I wrote a little bit of a research report I did for some of the buy-side guys on this. This is just the cosine wave function, and so not only are we talking about there's an underlying structure of geometry, but there's also this cyclical structure of space, but also in time. So the sine curve moves between, quarter pi, half pi, 3/4 pi to 2 pi. So we're all dealing with the same thing. So here I was just saying the existence of cycle proves there's hidden order behind everything, and there's a divine code upon which everything's constructed. So there's truly is a grand design within the complex, seemingly chaotic existence. So just like energy moving through a medium like water in physics, energy moves through the markets. And there's these cyclical structures, they exist in price, and they reveal themselves in the charts. This is interesting. There's another gentleman, a mathematician, came up with, it's this guy right here. His name is Mandelbrot. He was a French mathematician. Oh no, he studied and followed some of the stuff done by these guys. This guy was a French guy, Fautois and Gaston. And he kind of took some of this work on what they called fractals in the 20th century. And what it's all about is in physics is called complex dynamics. But there's these dynamical systems, but what you find is a lot of it has to do with time, and then it's based on geometry. But what this guy found is when you actually take those same models and you run it into a computer, guys can look up on YouTube. There's a cool thing. You just look up the Mandelbrot set, and you'll find these different videos where this computer will actually iterate itself. And what starts as a small pattern just iterates on itself and creates these fractal patterns where, this pattern, this pattern is the same pattern as the overall, this pattern. And then when you dive into the smaller parts, everything is a similar self-referring pattern, and it just goes off into infinity. But the computer can do this. You put in a simple code, and this is what comes out of the self-referring process. And so this is what happens in nature, is that the code, the DNA, whatever structure in all these different beings and things in life, the point is that this is a fractal model, or trading model, and so everything kind of builds off itself. But what we want to focus on is that it's the similar patterns on the 1-minute chart as it is on the monthly chart. Anyhow, that's just kind of what I was trying to explain here with the Mandelbrot set. And this is what it looks like, actually. So you guys can study that if it interests you on your own. It's pretty amazing, though. I mean, so now they're finding the similar things in genetics and all this stuff it's all kind of intertwined. So then when you start to learn about what's called dynamical systems, you get into what's called the equations of motion. And so when I started to look at that, you start to see a lot of things come up with oscillations. And that's why I like to use the slow stochastic, because it's an oscillation. And I can kind of go through some of this. And there's another system called the Lorentz system. It's been known as kind of the strange attractor theory. I don't know if I want to get into it. But this is kind of how markets work too, is sometimes there's a specific level that all the market wants to trade to, and then everything reverses. It's kind of similar to this, to the Lorentz system. You guys can look this stuff up on the internet. But this loops. There's a little loop in here. It loops, it loops, it loops, and then it jumps like sideways in a different dimension. And so this just shows you things aren't linear. Things are more dimensional and dynamic, right? So most of the trading models are all very linear thinking. We have to think more cyclical and more of a dynamic system. So here I'm just talking about equations of motion. It has to do with momentum, which is price, and then time is obviously what we like to focus on. And this gets into the physics, some of Newton's laws. I don't get into that. I think the key thing, guys, to realize is momentum, time, and then there's different classifications of motion. But to me, it's the oscillation that usually is the most helpful in markets. So again, that comes down to this is what we're talking about. That's just one of the several indicators, but I like to keep it kind of simple. So guys, you want to think of the markets like this too. So sometimes everything's flowing together, right? The dollar could be rising, rates are rising, and then sometimes one cycle will shorten up and they'll go opposite to each other. So one's peaking, there's one asset, or maybe bonds are making a high, and then stocks are bottoming out, And that's what just happens. Sometimes these cycles come together, and sometimes they're going opposite. And so when these waves line up, that's when you get the big moves. When you have a lot of different markets going a lot of different ways, that's what makes it really choppy. So this is me just describing more of the different types of waves. So when I think there's two main types of waves, transverse and longitudinal. So you guys should learn these. So transverse and longitudinal, right? Sound waves are longitudinal, and I think of those as more range trades. So when you have a high and a low, equidistant highs, equidistant lows, right? You get this choppy longitudinal wave type formation, right? And we don't want to get at least in my opinion, and how the model trades, it's always the toughest trading in the middle of these choppy markets. Like if you get stuck in a small time frame trying to you're trying to buy here, and then it reverses on you, and then you get short here, and then it reverses on you. You tend to get chopped up in the middle of the range trades. So when you get these, I'll show you guys how to identify this stuff. It's kind of an art, but you'll start to notice the same thing. When you get a market that's acting like this, you want to stay at the wides, or that they call the wings. You want to stay on the wides. If you get chasing the trend in the middle, you're going to get a lot of stop outs and reverse, and it's going to stop out and go against you again. So it's easier to go contrarian when you have that type of wave structure. So you stay wide, and the way you do that is, I guess what I'm trying to say is that trending markets, I'll show you in a second, move more like a transverse wave, and then the sideways range trades are more longitudinal. And you play them different. So one that's trending, you can get aggressive on the high or low. All right? When you're in a range trade, if if you think this is the bottom of the range, you got to buy it really small, and you have to give yourself a wider range and more size to be able to handle it if it stretches out and then comes back into the range. It's just a different way to play it. And then you want to take your profits in the middle of the range and start doing the opposite. You kind of work a scale back into the top of the range. We'll work on this stuff. But I mean, make no mistake about it. This is a range trade. It's the same wave structure. And then so the transverse wave is a little bit more trending. And this is more familiar, right? So that's the idea. So then the model then has a complex dynamic structure, and the trading system's based around these patterns in motion. And then we discovered the fractal nature of time, and we built that time component into the model. So the fractal nature of markets is similar to what we find in nature, and the idea is that, you know, what you find on the leaf is the same as the branch, and that's the same pattern as the overall tree. And we wanted to build a model that was similar and could take advantage of all that same type of movement. So fractals, it's Latin meaning fractus, or broken or fractured. And again, it's just back to this self-referring process. And it's just all throughout nature. DNA is a perfect example of that. This is a Coke, or I'm not exactly sure how you say that, but it's a snowflake. The same little pattern here is the same pattern as the overall snowflake. So that's what we mean by the fractal nature. So if you hear me say that. All right, so now let's get into the actual model and the overview.